traders, hope you are having a great day. Welcome back to Store Capital, and today we'll be learning what are fair value gaps and all the different types of fair value gaps that you get. So without further ado, let's get straight into it. A fair value gap is a three candle formation that happens in the market when the second candle, which is the middle candle, has been left unfilled. So the ICT index definition of a fair value gap is that a fair value gap is a concept in trading that refers to a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void. So if we look at the charts here, we have three candles on each side. So the first three candles are all bearish candles going down. If you look closely here, you will see that on the first candle, the low of the candle wick, to the third candle, the high of that candle wick, you'll notice that the two wicks do not overlap. So when you have a situation like that where a wick and a wick does not overlap, that is when you have a fair value gap. So if I take out my rectangle and I mark it out here, that would be our fair value gap. As you can see, the two wicks do not overlap, which creates the fair value gap. But if, for example, we had the two wicks overlapping, so let's say this wick over here at the bottom was a bit higher, and the wick here at the top was a bit lower, we would not have a fair value gap as the two wicks overlap each other. So this is an example of what is not a fair value gap. So let's go into some examples on the chart. Here I have S&P 500. I'm just going to mark out a few examples of fair value gaps. So if you look closely here, you will see at the top that we have a candle here, then we have a huge drop, then we have a third candle. If we look at the first candle and the third candle, we'll notice that the wicks do not overlap. And that is a fair value gap over there. So we take our rectangle and we mark it out. And that is what is a fair value gap. A few candles later, you will notice that we had this bearish candle, which is the first candle, then this bullish candle, which is the second candle, and this bullish candle, which is the third candle. If you mark the three out, you will notice that we have another fair value gap in that range. So these are fair value gaps. So when we come back here, so we have two types of fair value gaps. The one on the left is known as a SIBI, which stands for sell side imbalance, buy side inefficiency, meaning that if we draw off our fair value gap again, let's just drop this wick here. We've created a fair value gap now. This is a SIBI, a sell side imbalance, buy side inefficiency. The imbalance is towards the downside, so it's a sell side imbalance, and because there's no movement within this range going up, that's a buy side inefficiency, hence the acronym SIBI. And if we move over to the right side, we have the exact same thing. If we mark out our fair value gap on the right side, you will notice that we have a buy side imbalance, and because there's no movement within this range, a sell side inefficiency. So a bearish fair value gap is a SIBI, and a bullish fair value gap is a BISI. Okay, so this going up here is a BISI, as it's a bullish fair value gap, so it's a BISI. And this over here going down, this fair value gap over here going down, is a SIBI, as it's a bearish fair value gap. Now over to the next concept is a BPR, a balanced price range. A balanced price range is when we have two fair value gaps that overlap each other. So if we look at the charts here, we'll notice that we have this bullish fair value gap and we have this bearish fair value gap over here. But if you look closely, you will notice that they overlap each other. So you're going to mark out the part that overlaps from the first fair value gap to the second fair value gap. So what I've just marked out is what we consider a balanced price range when two fair value gaps overlap. If we look here at the bottom, we have the same scenario. We have this SIBI over here and we have a BISI over here. And if we take out our rectangle and mark out the area that overlaps, we will have our balanced price range. So this would be our balanced price range for this area over here. Okay, the last two things we're going to look at is a gap and a volume imbalance. We're going to look at these two side by side as people often get them confused. So a gap is when there is a complete gap between two candles, meaning that their bodies don't overlap and their wicks don't overlap. So when we have this is what we consider a gap. And a volume imbalance is when the wicks overlap but the bodies don't overlap. And if we mark that out, this is a volume imbalance. And at the bottom, there's another one right here. That would also be a volume imbalance. But because the wicks don't overlap here, this is a gap. So people often get them confused. I hope that the way I explained it now makes it much more simpler to understand the difference between a gap, also a liquidity void, and a volume imbalance. Okay, so let's go into the chart and look at a few examples of volume imbalance. Because this wick overlaps with this candle's wick, this would be a volume imbalance. So let me come in closer so you can see it. That is a volume imbalance. Another example over here, where the wicks overlap but the bodies don't touch. This here, let me change the color. Okay, that is a volume imbalance. Another one right here, volume imbalance. This over here, volume imbalance. So as you can see, it's not really that difficult to look for volume imbalance. They're everywhere in the market. Okay, so now I'm here to show you what a gap is. So if you look here, this candle and this candle, the wicks do not overlap, the bodies do not touch. So that space we have in there is what we call our gap. So as you can see, I've just marked out the gap between the candles. That is how a gap should look. And if we look to the left here, we have another example where the wicks do not touch. So we mark it out and we extend it to the side. That is a gap. And another one here, where the market was actually going down. We go down and we extend the rectangle to the side, we would have marked out our gap. So this is how gaps look, and I hope that now you do not get them confused with volume imbalance. So that sums it up for the video. I hope that you took some information and learned something. Please hit the like button and don't forget to subscribe, and peace out.